We'll be running through our US fourth quarter 2023 tech strategy and stock picks. We'll be focusing mainly on your tech sector, but we also will talk a little bit about, I guess, a couple of slides on your financials and just your overall macro view of what's been happening over the last quarter. So, just a gentle disclaimer. Right, like I mentioned earlier, the content for today, dive through the performance review for the third quarter, some macro and sector themes, our stock picks for the next quarter and I guess the near-term future. And then we'll round it off with a technical pulse by Zane, as well as a short conclusion, which will be followed by a Q&A. So feel free to post any of your questions in the Q&A tab, and we'll get to it at the end of the presentation. So jumping straight into what happened over the last quarter. Basically, equity markets were relatively sluggish. You can see the box on the left, S&P 500, which is a broad-based index, was down about 4%. For the year, the S&P 500 is still up about 12%. Most of these gains obviously came in the first half after a big surge from AI. When you look at the NASDAQ 100, or most of which encompasses most of your tech companies, the NASDAQ 100 was also down 3% for the quarter, but still, up quite significantly for year to date, up 35%. When you look at, where most of these gains came from, for not just the S&P 500 and the NASDAQ, most of these gains came from the FANG companies, or I guess if you talk about right now, you're talking about the Magnificent Seven companies, so like Tesla, NVIDIA, Apple, Amazon, and so on. These companies contributed to most of the gains. If you strip out these 7 companies from the S&P 500, year-to-date performance would have been maybe up about 1 or 2%. So, significant contribution from these guys. Interestingly, the biggest decliner for the quarter was actually bonds, and this was mainly due to a sharp increase in treasuries. So essentially, if you had your traditional 60-40 portfolio, 60% equities and 40% portfolio, 40% bonds portfolio for the last couple of years, your portfolio will essentially been decimated because bonds performed so terribly over the last couple of years, while equity markets were really quite bad last year, although we're seeing a little bit of recovery this year. So in terms of currencies, we won't really spend too much time here, but in general, the US dollar strengthened versus most major currencies. You can see here that the euro and the pound, 3% and 4%. Well, actually, surprisingly, the Sing dollar actually held its strength versus the US dollar compared to most other countries, not just for last quarter, but for this whole year in general. So when you look at the individual sectors, energy, was the only one that actually did well in the third quarter, and this was mainly due to higher oil prices. If you look at most of the other sectors, they were down quite significantly. I mean, communications was up about 1%. But you look at the bottom of the bar chart here, most of the companies here, most of the sectors like the real estate and utilities, those are your interest rate sensitive sectors. A big reason for this is the market was initially pricing, I guess, less rate hikes and faster rate cuts, but this didn't really happen, and so these interest rate sensitive sectors kind of took a hit. When you look at what was really big in the second quarter, and this was AI related companies, we had a chart. I believe we had a chart previous strategy and stock pick, if I'm not wrong, but you can see that most of the AI related stocks, they were up. Stocks like Supermicro and C3 AI, they're up about 160 to 200%. So they essentially almost tripled in value. And we are seeing that a lot of these AI related companies have actually run out of steam. You see at the bottom, C3 AI is down 30%. Companies like AMD and Marvell also down quite significantly. And we think this is fairly natural after such a big explosion. A lot of profit taking is going on, and I guess a lot of expectations are kind of coming down slightly. When you look at the broad-based S&P 500 and some of its valuations, we think that right now it's kind of pushing into overvalued territory. So if you see here, the red line is about 1 standard deviation away from the average, and the 20-year average, while the S&P 500 is about 18 times. If you go back to like 30 or 40 years, I think the average is even lower, about 15 or 16 times. But essentially what we're trying to say here is that the equity markets and S&P 500 right now, it seems to be a little bit overvalued. Although this doesn't mean that markets can't continue to go up, but it's kind of just an indication that maybe it's getting a little bit overheated. And we did see a slight pullback over the last couple of months or so. A similar story for the Nasdaq, not too dissimilar from the S&P 500. Obviously, the Nasdaq's forward PE average is a little bit higher, 22 times compared to 18 times. But similar story, it was almost about 30 times, trading at 30 times forward PE. But this has come down a little bit, to about 26, 27 times, but it's still close to one standard deviation away from its long-term average. So when we explore, one of the reasons why equity markets perform, I guess, relatively poor in the last quarter, a big reason is because treasuries, like I mentioned earlier, continue to climb. You can see here in this chart, from a period of March 2020 to about March 2022, treasuries are relatively low, and the equity markets were just climbing on top of it. But after that, I guess when the Fed started to raise interest rates and the US 2-year Treasury, which is the line in orange here, started to really pile on, increase quite significantly. Then the markets got a little bit wobbly, and that's kind of what we saw. It was one of the reasons why we saw equity markets perform poorly in the last quarter. When we look at the S&P 500 versus the Treasury earnings yield spread, essentially it's your equity risk premium. So what happens is Treasuries, given that they're the safest form of investments, you have no premium on it, but as your equity products or your investments get more and more risky, by right it demands higher premiums. So for S&P 500 in general, the average has always been about the average over the treasuries has always been about 2 to 2.5%. But right now it's basically trading to almost on par. And when we talk about the S&P 500's earnings yields, essentially it's the inverse of the price to earnings ratio. So instead of the price over the earnings per share, it's earnings per share over the price. And so essentially it gives us it's a yield, and it just gives us an idea of how maybe money managers are viewing equities versus fixed income right now, or treasuries right now. And so right now it's near the red line, which is one standard deviation away. So essentially what it's telling us is that bonds, or rather treasuries right now, seem to be a little bit I guess more in favor, or seems to be a little bit more undervalued compared to equities, and should actually outperform over the next 2 to 5 years, in theory. So similar thing for longer term treasuries, like the 10-year here. It's not so much as it's not one standard deviation away, but it's fairly close to it. It's slightly just above parity compared to the S&P 500. So that's all for the macro view. We'll move on to that's all for the review. We'll move into some of the macro themes that we're seeing right now. The first theme, everyone's talking about it, and it's really been in the media for the last year and a half or 2 years, is interest rates and interest rate hikes. So our first theme is that the Fed, we think that the Fed's going to go higher for longer. I mean, it's almost a given. They've already stated that numerous times, especially over their last FOMC meeting, that they're going to be continue to maintain a more restrictive policy instead of easing so fast. And when we take a look at why, the one of the biggest reasons is still inflation, that it's relatively high. It's essentially double the Fed's target of 2% right now. And when you talk about inflation, really talking about two things. Services inflation, which is like your rent, your hourly wages for restaurants and stuff like that, and goods, which are goods like your non-durable goods, like your laptop and all that. You can see that the goods inflation has kind of collapsed. It was really high in the middle of 2022, because there were a lot of supply constraints and so on. But this has really collapsed. But the main thing that is still holding up core inflation is services. It's still remaining fairly high. And a big reason for this is because the housing market is still, it is cooling off a little bit, but these measures are kind of delayed. So we don't really see the full effects instantly, and so it takes some time for measures like your the services or your goods inflation to actually come down. Interestingly enough, the announcement for PC should actually be coming out in about an hour, so it should be interesting to see where how much has inflation come down compared to last month, or I guess a couple months ago. So in terms of the Fed funds rate right now, it's sitting at about 5.3%. So almost at the peak of core inflation, which was 5.4%. Like I mentioned earlier, core PCE right now is 4.2%, and we do think that rates will hover at around this 5.3, 5.5% for a little bit longer than the market expects. Mainly because Fed Powell has maintained his stance that he really wants to make sure the inflation starts coming down and not to repeat any of the mistakes that he's made in the past. So it'll be interesting to see how this kind of plays out. When we look at the Fed funds futures expectations, so essentially what the market is pricing in, what this chart tells us essentially is that the market isn't really sure what to do. The line in orange right now is actually the expectations on the 1st of July, so the beginning of the quarter, and the line in blue is actually the expectations at the end of the quarter. And so you see there's this kind of re-rating upwards where the market, when you look at December 2024 on the right, the market instead of expecting interest rates to be about 4%, now they've moved it up to 4.7%. So it's 63 basis points, or 2.5 to 3 hikes compared to what I thought earlier. But what's even more interesting is that even though the Fed has mentioned and has actually put out its own Fed funds projections for the end of 2023, expects interest rates to be about 5.6%, whereas the market still thinks it'll be about 5.4, 5.5%. So almost there, but not quite. And what's even more interesting is that towards the end of 2024, the Fed only expects to cut rates twice, whereas the market is pricing in about 3.5 to 4 rate cuts. So it still really doesn't believe that the Fed's going to maintain interest rates higher for longer. Which I guess they have their reasons, but essentially they're just calling the bluff on the Fed. And the biggest reason for this is that a lot of the market economists actually expect inflation to fall quicker, faster than expected. What's more interesting is that usually when the Fed pivots and when it starts cutting interest rates, that kind of leads to the market downturns, mainly because biggest reason is that usually after it raises rates so much and it keeps it there for so long, there is generally a slowdown in economic activity, which kind of plummets the economy into a recession, and the Fed's kind of forced to cut rates. So it has been proven quite accurate in the past. This is only the last 3 instances, but I believe in the last 7 times spanning over the last 40 or 50 years, almost every time it's happened. So it'd be interesting to see, whether this actually happens next year when the Fed starts to cut rates. We do think that essentially the economy is right now in a much better position compared to where it was in the past. Unemployment is still relatively low, and I guess most of the companies are still a bit more profitable. It's not so heavily skewed towards your big companies. So it would be interesting to see whether the market does kind of fall off a cliff, or whether there'll just be a small correction sometime next year. Our second macro theme is that we're looking at several indicators that are giving us mixed signals. So the first one we've shown quite a bit is your yield curve spread, which is your 10-year but minus your 2-year. It's been heavily inverted, and it's most inverted in the last 40 years, and it's stayed inverted for over a year now. Similar to the last chart, what we usually see is that whenever it reverts back above 0 and kind of heads towards the 0.5 or 1% range, that's usually when markets start to falter and when a recession kind of starts. But obviously these kind of reversions are super steep. So if we do get maybe a gradual reversion, then maybe there wouldn't be a recession, although it's still very difficult to tell. But essentially the bond market is still pricing a recession, They thought it'll be this year, and then now they've just pushed it towards next year. We're not sure if we head into next year, they'll kind of push it down into 2025. But I guess everyone just it kind of is taking just a wait and see approach. We look at some of the PMI numbers for manufacturing. It's starting to improve a little bit. So it's not quite yet above 50, so it's not really expanding yet, but it kind of looks like it's found a base. It's hovering about 48 right now. So there are, I guess, some green shoots for manufacturing. In terms of services, it still remains fairly resilient. It's still expanding, and one of the biggest reasons is employment, almost full employment, and still pretty strong hourly wage growth. And our last macro theme, we continue to see earnings headwinds. We do expect earnings headwinds to still persist. I believe we did show this chart once before, but when you look at your S&P 500 forward earnings growth, essentially it's what the market thinks. The S&P 500 as a whole, the earnings for the broad-based market should grow in next year. So forward earnings is usually just 1 year ahead. It's still below zero, so it's still kind of contracting. And usually what happens when this kind of drops below zero is that you see sort of a steep drop off in equity markets with these circles, these red circles here. But what we've seen over the last year is some sort of a disconnect. You can see in the right side of this chart, earnings, EPS growth has really fallen quite significantly. But the market really didn't. It sold off a little bit last year, but it's rebounded fairly strongly this year, which is a little bit of an anomaly. So we do expect a little bit of weakness in the market, because in general, if earnings don't really grow, it's very difficult for the market to move higher. I mean, you can re-rate your expected PE ratios, but it is a little bit more difficult if earnings aren't expected to grow that significantly. The biggest reason for this is that a lot of people talk about a lot of your big tech companies which are seeing earnings or expecting earnings to grow quite significantly, but for the rest of the other, I guess, 490 companies, the situation isn't that great. It's not terrible, but they are still dealing with a slowing economy, and earnings for a lot of these companies are still relatively flat and not really showing much momentum to the upside. So I believe that's all for the three macro themes. We'll now move on to our sector trends, and I'll hand it off to Glenn to kind of get us started with financials. Glenn?
Hey, thanks, John. Yep. So we'll just start off with a quick sort of recap on the financial sector for the US. We don't really cover them, but just to give a quick highlight on what has happened to at least the four main banks in America. So we'll be covering mainly JP Morgan, Bank of America, Citigroup, and Wells Fargo. So you can see that our title is continued net interest income growth boosts earnings. And you can see this from the first red box here. You can see that net interest income has grown quite significantly year on year for the second quarter for all four banks, with JP Morgan leading at 44%. But you can see it's all double-digit sort of growth percentage-wise. But I think the main drawback would be the investment banking, which leads me to the second red box here. You can see that Citigroup has the lowest, as in the biggest decline at negative 31%, whereas the rest have sort of managed to stabilize their investment banking sector. And this has also resulted in the non-interest income for Citigroup being the only one that declined by 28% year on year, whereas the other three banks have shown an improvement, and this is sort of a reversal of what has happened in the last few quarters. And I think the other significant point I'd like to bring up would be the provisions change. So just to explain a bit on how we came up with these figures, this is basically how much if it's a positive number like here, it means that the provisions have increased. This is how much the provisions have increased year on year from the first quarter. So you see across the board, it has all increased for all four banks, with JP Morgan being the highest. And I think this will sort of lead me to my outlook for the banks, is that as John has mentioned earlier about how the rates are higher for longer, it's definitely beneficial for the banks, where they can have higher net interest margins, which will lead to higher net interest income. So we should continue to expect to see their net interest income growing quite strongly year on year for the next few quarters, while the interest rates are still high. But that being said, the higher interest rates are also a double-edged sword for the banks, and that will lead to sort of higher provisions. And we could continue to see that the provisions change will be higher year on year for the next few quarters at least. But you can also see from the PATMI line at the bottom here, this sort of provisions change and sort of a decline in the investment banking has not really hampered their PATMI growth. I mean, except of course for Citigroup, which was a quite significant decline. So all three banks, the JP Morgan, Bank of America, and Wells Fargo, has shown very good year-on-year increase in their PATMI. And I guess for Citigroup, it's a bit of a catch-up to try to balance both their investment banking and their trading to sort of bring their non-interest income back to either flat or maybe a very sort of low single-digit increase year-on-year. So I guess that's what we'll be looking out for the next quarter earnings. So that's all I have for the financial sector. I'll now hand it over back to John. Thanks.
Thanks, Glenn. So moving into our next sector trends, and that's EVs, and we spoke a little bit about it last quarter. But EV deliveries are going to heat up quite significantly. When you look at your total EV deliveries, how you derive these numbers, we essentially got deliveries for all your big players. So when you talk about big players, it'd be like Tesla, BYD, and your Volkswagen and Audi group, and some of the other Chinese EV manufacturers as a proxy for the overall market, because essentially these guys make up 90+% of the overall market. As you can see from the second quarter, over the last 2 years, deliveries have been growing at almost a 90% compound annual growth rate. Essentially, they're almost doubling every year, which is quite significant. And there are many reasons for this. The first reason, there's no shortage of demand. EVs continue to improve in terms of quality, build quality, technology range, and price reductions, and so it's a little bit more attractive for consumers. When you compare it versus internal combustion engine vehicles. At the same time, there's a lot of policies in place in the US, in Europe, and especially in China, where they're promoting a lot of your zero emissions vehicles. This is driving a lot of demand for EVs because people are seeing they're kind of thinking of EVs as if I'm going to have to convert in the next 10 years, I might as well just do it now, since most of these EV cars are very comparable, especially with rising prices of petrol and oil around the world. It kind of is pushing a lot of consumers towards at least thinking about purchasing more EVs. The next point of why deliveries are continuing to mount is because I guess over COVID, a lot of these companies actually started to ramp up production for their EVs. And so because the ramping of production is kind of slow at the beginning, and then as it takes off, then they can really exponentially deliver more vehicles. And it's just a timing thing, and it's what we're seeing right now, especially in the industry it's still relatively in its early stages. So we do expect eventually deliveries to at least the growth rate for deliveries to come down a little bit, but we still expect it to be relatively high compared to a lot of other industries right now. When we think about EVs compared to the overall total vehicle industry, right now EVs make up I guess 1 in every 4 vehicle sales is actually an EV. We do expect this to increase to about 1 in every 3 by 2026, and by 2030 we do believe that at least half of every vehicle sold will be an EV. Obviously, the biggest reasons for this is, like I mentioned earlier, is you have your policies, you have your improving prices, and your better efficiency from these. When we look at just your market share, the EV market is still really dominated by just a few companies. And this chart is actually quite interesting because there's this narrative that BYD is actually the largest EV player in the world. But this is not 100% accurate because whenever they mention this, they lump in a lot of your plug-in hybrid vehicles for BYD, and BYD does sell a lot of plug-in hybrid vehicles. Whereas what we're looking at right here is just pure play EV. So essentially what I did is I went to all these manufacturers and we took out a lot of. We only selected their pure play EV models and the delivery numbers to derive a rough market share. And what we can see is that Tesla is still kind of going strong at 37%, while BYD is about 27%. So obviously something that's a little bit concerning, but is kind of natural, I guess, is Tesla's market share continue to dwindle. At its peak, it was almost 70% of all EV vehicles. And as more and more, as the industry kind of matures a little bit and more competitors start coming in, it is expected, that your market share kind of gets eaten away a little bit here and there. Although it's worth mentioning that Tesla has done a pretty good job at actually maintaining its market share over the last few quarters. When you look at the other competitors other than BYD and Tesla, you've got your Volkswagen, your BMW. They're at 15 and 18% respectively. So still pretty good because they are relatively early movers in the EV space, and they set aside a lot of I guess a lot of budget to develop their EV software, their EV production facilities, and so on, quite a number of years ago compared to companies like GM and Ford and so on. Yeah, so I just thought this was quite interesting. Tesla is still by far the leader in the EV market space in terms of just deliveries by quantity. What's more interesting is that half the world's EVs are currently in China. So I think there are like 5 or 6 million EVs in the world, and half of them are actually just sitting in China. And that's just how far ahead China is compared to the rest of the world when it comes to using EVs and manufacturing. Moving into our next sector theme, and that's on the semiconductors. We are starting to see some early signs of recovery in the semiconductor space. When you look at this chart, it's showing that semiconductor growth or semiconductor contraction has actually narrowed quite significantly. So you look at this red circle on the right side here on the chart. A quarter ago, semiconductor revenue growth was like negative 20%. On a trailing 3-month basis. But right now, this is improved to about negative 10%, so it's quite a significant improvement. And it's crossing over the trailing 12-month line, which is in orange. And usually what we see, and it's quite a pattern, a very cyclical pattern that whenever the blue line kind of crosses above and above the orange line, usually it kind of depicts some sort of recovery underway. And that's something that we expect to see moving forward in the semiconductor space. And when we talk about semiconductors, a lot of people are just thinking right now about NVIDIA. Yes, NVIDIA is a big part of it, but it is only a portion of it. There other than NVIDIA, there are other players, other I guess subsectors of the semiconductor industry. But of course, NVIDIA, over the last 12 months, they've seen their sales year-on-year performance essentially double because of the strong demand from generative AI. So you see, they're the main outlier. When you look at the other, I guess, components like CPU, the main players for CPU are AMD and Intel. So they produce a lot of the chips that are in your PCs, your smartphones, and all that, and cars even. And then you've got your memory segment and your memory. So your SSDs, all the memory spaces in your devices. And the main players for memory is Micron, Samsung, and SK Hynix. And so what we're seeing from CPU and memory is that there is some sort of stabilization in terms of sales performance. And we do expect these two segments to actually start to improve a little bit. I mean, sales is still contracting year on year, but we do think that at least for CPUs, this should be relatively flat over the next quarter or so, compared to memory. Although at least is some sort of stabilization is better than just continued decline. On the flip side, we do expect the GPU recovery to at least start to drag the overall market up, which is kind of why we mentioned in the earlier slide we think that there should be or there are early signs of recovery for the overall semiconductor market. Yeah. So with that, we'll move on to our fourth sector theme, and that's on SaaS companies. I'll hand it over to Ambrish to talk about SaaS, which is software as a service.
Thank you, John, and good evening, everyone. So let's move on to our next sector, SaaS. Next slide, please. So SaaS, it basically is an abbreviation for software as a service companies, and they basically deliver their software applications over the internet. And SaaS companies, they have a subscription-based business model, and as a result, their revenues are recurring in nature. So there's more visibility in the future revenues. So market is expecting a recovery, and we believe that in the fourth quarter, and this is mainly because of two reasons. First of all, most of the SaaS companies, they have integrated AI across their products, and they have started to commercialize them. So for instance, Adobe, it has introduced its AI tool, which is Firefly, into its photo editing platform, which is Photoshop. So with that, users can generate images via text-based prompts. And similarly, Microsoft also has integrated AI into its Office 365 software. So this can help users to like create the first draft of presentations or draft an email. So overall, the AI should boost the demand for the products for software companies. And secondly, since the software companies, they have introduced new features and innovated their products of late. So as a result, most of the companies, they have announced a price hike. So for instance, Adobe, it expects, it plans to increase pricing for its core products like Photoshop and the Premiere Pro, which is video editing application. So it expects the pricing to increase by about 10% beginning in November. And similarly, Salesforce also has increased its pricing by about 10% in November. So as a result, this should provide a tailwind to the top line growth. And so, sorry. So basically, we have just bifurcated the 6 major software companies into 3 categories. And the first one is ERP, Enterprise Resource Planning providers, which are Oracle and SAP. Secondly, the customer relationship management providers like the major one, which is Salesforce, and productivity softwares for Microsoft and Adobe. So if we take a look at the green line, it basically highlights the revenue that the Microsoft and Adobe has generated. It's the growth rate based on the last 12 months of sales generated. So, sorry. The green line, it has consistently remained consistent. It has not fallen throughout the pandemic, and we believe that the main reason was that the enterprises, they did not cut their spending on productivity softwares in order to remain competitive. And this is in the fourth quarter of the productivity software providers, they are expected to witness a recovery in the fourth quarter. Meanwhile, the enterprise resource providers and CRM providers, over the last few quarters, they are witnessing a decline in revenue growth, year-over-year growth rate. However, we believe that based on the guidance, this should have bottomed out. This should bottom out by the end of the fourth quarter. And mainly because any further deterioration due to the lower spending by enterprises, this should be offset by high demand for its AI-led demand for its products. So next slide, please. So moving on to our stock picks for the fourth quarter. Overall, for the Fangam stocks, the earnings in the second quarter, it recovered sharply. And the main reason for this was the cost cuts that were job layoffs that were announced by major Fangam players like the Microsoft. So the most of the cost cuttings, they have started to show in their bottom line. And meanwhile, for the quarter guidance for the next quarter, September ended quarter, revenue, it's expected to grow, and mainly because first of all, it's led by the AI-led product demand, and secondly, customers, they are showing increasing interest in the cloud and It's they are in cloud and digital advertising products, and also meanwhile, we believe that the demand for tech hardware like the iPhones and the first PC sales, they are still witnessing to witness a headwind in the September ended quarter. So next slide, please. So moving on to my stock picks. First of all, Microsoft. We have the we have the title cloud continues to be the driving force. So basically for Microsoft, we believe that there are two main growth drivers. First of all, its intelligent cloud segment, which includes its cloud service Azure, and the second segment, which is productivity and business processes segment, which mainly includes its Office 365 product. So the demand number of users and revenue per user for both of them is rising consistently. So these two segments, they contribute like about 70% of the Microsoft's total revenue, and they are the major growth drivers. So in terms of Azure, it has a market share of about 23%, and it has doubled over the last 5 years. Meanwhile, excuse me. Meanwhile, AWS has a market share of 33%, and Google Cloud, it has a market share of about 10%. So we believe that the Microsoft, it should continue to gain market share mainly because of the digital transformation trends and also its integration capability with Office 365. And Microsoft, it claims that it has a pricing power over AWS. So Azure revenue, it has been moderating over the last few quarters, mainly because of slower IT spending. However, we believe that it has stabilized now, and in the September ended quarter, Azure revenue should grow by about 26%. And any decline due to the lower IT spending, it should be offset by the higher demand for its AI-led products, like and for its cloud computing solutions. So any growth in Azure, it should benefit Microsoft mainly because it's a high margin business. So moving on to our second thesis, Office 365. Microsoft, it has a 90% market share in the global productivity market, which includes its Office 365 software and and collaboration teams software, which is Teams. So despite the 90% market share, the demand for Office 365 has been continuously rising. So for instance, the commercial revenue from Office 365, it has been rising by about 15 to 16% over the last few quarters. And the demand is mainly coming from small and medium enterprises and the frontline worker offerings mainly due to the rising need to manage tasks and workflows. Excuse me. If we look at the red line, that's the more personal computing segment, which has been declining over the last 3 or 4 quarters. And this is mainly because of a weak demand for the personal computers. And this is a weak demand for PC sales. It's mainly impacting Microsoft's Windows segment revenue as well as devices business. And this is mainly because like under Windows, it generates a Windows OEM revenue, and this particular revenue, it mainly generates from PC manufacturers like the Dell, Intel, who install Windows software on their machines. So it's likely to witness a drop mainly because of lower PC sales, and also its devices businesses segment, it's likely to be impacted. In the September ended quarter, it's expected to see a drop of about 30%. Devices segment, it mainly includes the sales of tablets and PC accessories. So overall for Microsoft, we have an accumulate recommendation with a target price of $372. Next slide, please. Moving on to my second stock pick, which is Airbnb. We have a title booking volumes jump as travel rebounds. So basically, Airbnb, it's an online marketplace for unique experiences and homestays. So if we look at the chart, the bookings volumes for Airbnb, it has been consistently rising. And last year in FY22, it had already surpassed its pre-pandemic levels of 327 millions in FY19. So this is mainly because of this rebound in travel, and it's witnessing three major trends, Airbnb. So first of all, it's witnessing a trend that the cross-border bookings have surged significantly, and this is mainly as the COVID restrictions they have eased, mainly into the Asia Pacific regions. Secondly, it witnessing more bookings into the urban regions. So the guests, they are returning back to urban cities. And thirdly, the long-term stays like stays of over 28 days, it has also been consistent, like it contributes about 18% of the overall bookings, like which is like about 75 million for the full year. So this is due to the flexibility of a remote work environment. And meanwhile, Airbnb, its profit has been consistently rising. So like last year, it reported a maiden net profit of $2 billion. And we believe that the profit should continue to rise, mainly because of top line growth as well as through higher operating leverage. Moving on to our second thesis, the listings on Airbnb's platform, it has also consistently increased. In the June ended quarter, it reported that the active listings, they grew by about 19% to 7 million listings. And we believe that this is mainly because of continuous addition of new features and providing support to hosts. Like they have recently introduced a new feature wherein pricing tools, wherein the host will get an idea like what are the pricing that are charged for the similar properties in the nearby regions, and accordingly the host can decide on the pricing. And also it had recently introduced features like Airbnb rooms and monthly stays. So and another reason could be a jump in its listing could be that the host, they might want to be earning an additional income through their properties, and as a result they could be listing their properties on the platform. Meanwhile, we believe that Airbnb, it has one risk, like the daily rentals on its platform, it's expected to be remain under pressure, at least in the near term, mainly because as mentioned earlier, guests, they are returning, the guests, they are booking more volumes coming into the urban cities, and the urban regions mainly have smaller apartments are smaller in size, and as a result the rental rates are lower, so this might impact the average daily rates. And secondly, it's a consumer discretionary spend, so any increase in inflation or rising interest rates, if the travelers, they decide to pull back on their spending, then it might impact Airbnb's volumes. But we believe that overall for Airbnb, it should benefit. It's well positioned to benefit from shift to alternative accommodations, mainly because they are more family and group travel friendly, and also they are cheaper as compared to the hotels. And it also offers guests like they can stay for a longer period due to the flexibility of remote work environment. So overall for Airbnb, we have an accumulated recommendation with a target price of $152. Next slide, please. Thank you. So for Salesforce, we have the title Profit Rises on Cost Cuts. So Salesforce, it's basically a software as a sales company, and majority of its revenues are generated via subscriptions, over 90%. So jumping straight to the positives for Salesforce, there is the demand for its products like the Salesforce and Service Cloud. The Sales Cloud and Service Cloud, it has been strong, and mainly because they help companies to manage and automate their sales tasks and to enhance the customer relationships. However, Salesforce, they have been focusing right now, their strategy is to have a multi-cloud adoption strategy. Instead of acquiring new customers, what Salesforce has been doing is it's cross-selling its products to its existing customers via its customer 360 platform. So that platform, it particularly gives a holistic view of the customer data, which instead of buying a point solution, a company would get a 360-degree view of their customer information. And secondly, as mentioned earlier, it should benefit from a price hike and the price hike that was announced in November in August, and this was the first price hike in almost 7 years. So it should provide a tailwind to its top line growth, and and it has also started to commercialize its AI tool, for Sales Cloud. It's charging about $50 and per month per user, and it didn't say what kind of revenue that it expects to generate in the future, but it did say that it's gaining traction at the moment and it should boost the demand for its products. So lastly, for Salesforce, the margins they have been expanding. Like for instance, in the FY20 in previous year, the this is January ended company. So in the last year, the operating margin, the blue line is the operating margin. It was about 3.3%, and it's expected to grow by about 14% this year and 18% in FY25. And similarly, net margin it's expected to grow, and this is mainly because of its focus on cost-cutting initiatives, mainly through job layoffs and real estate consolidation. So earlier this year, the company it had announced a job layoff of about 10% of its workforce, and majority of it has been already been completed. So with the digital transformation trends, as the companies they want to have a better they want to enhance their customer relationships. Overall, for Salesforce, we have accumulated recommendation with a target price of $242. So I would now like to pass on to Jonathan.
Thanks, Ambrish. Yeah, so I forgot to mention earlier that most of our stock picks kind of revolve around your digital advertising, some of your cloud players, so the industries that obviously are on the up. So my next counter here is actually Alphabet Inc. We do think that actually advertising looks to have bottomed, so it's actually on the up. When you look at this chart here, you can see advertising ad revenue growth on a year-on-year basis is actually declining quite sharply since 2021. Actually contracted in the fourth quarter of last year, but over the last 2 quarters, you've seen a little bit of an uptick. And there's inklings in the digital advertising industry that we should expect some sort of revenue growth to accelerate as more and more advertisers look to advertise their products. There was an initial worry that consumer spending was going to fall off a cliff, but so far it's been fairly resilient. I think that's why a lot of companies are after they've laid off all their staff, they realize like, maybe we still do need to advertise our product to drive a little bit of revenue sales. And so that's kind of, the biggest reason, one of the big reasons for why we think Alphabet, why we think digital advertising is on the up. Secondly, for Alphabet, rather Google, they're leveraging quite heavily on AI to drive better products and increasing a lot of its monetization on its products. When you say better products, most of it will come in the form of your digital advertising performance tracking products, or maybe they're leveraging AI, generative AI to have better placements, to have more intuitive ad placements. In terms of monetization, you've got your whole largely untapped YouTube Shorts platform. That monetization right now is still fairly slow compared to just your search ads. At the same time, when it comes to AI driving better products, it's also leaning not just in digital advertising, but also for its Google Cloud. So it's kind of incorporating a bit of AI into its Google Cloud services and making it, I guess, not just a standalone product, but giving more tools for customers to use and to, for example, like giving them AI tools to analyze data better, or to actually do some coding for them. Lastly, we think that a leaner cost structure in general is going to bear fruit with increasing operating leverage. Alphabet, like most other major tech players, laid off quite a number of workers over the last year, and we are starting to see, I guess, from a cost perspective, the fruits of those layoffs. Because initially, once you lay off someone that there is significant, and not just layoffs, but when you're downsizing your office facility footprint, there are a lot of costs that are associated with it, like just your severance related costs, as well as when you break leases, you just have to pay a lot of costs, and these costs are incurred the moment you lay off people, or the moment you start doing these cost cutting initiatives. So essentially, for the first 2 quarters of this year and the last quarter of last year, there were a lot of these costs kind of baked in, but this is kind of run through now. But we're starting to think that Alphabet, like a lot of other tech companies, should benefit because they have a leaner cost structure, so they're able to be a little bit more efficient with a little bit less resources. We have a buy recommendation with a target price of 144 on Alphabet. So moving into my next counter, which is Tesla. Not really that much to say here. I did speak about EVs quite significantly just now. For Tesla in particular, they have by far the most superior products. I think you can say that some of the high-end BYD products are also pretty good, but in general, overall, when you look at all their vehicles and from an EV standpoint, plus their battery storage, it is relatively more superior compared to most of its peers. There's also no shortage of demand. Admittedly, a lot of the wait times for deliveries have come down quite significantly because they've ramped up production so quickly. But that's just a testament to how efficient the company can be in terms of ramping up and still maintaining such strong demand. In terms of our second point, we think that they still maintain quite good margins for its relative to its industry. So when you talk about margins, right now their vehicle margins are about 18 to 19%, and that's more than double the industry average of about 8 to 9%. They're able to do this because they leverage a lot of transformative design features. Where they're able to design their vehicles with less parts. They're also able to I guess on the production line, they've also managed to make it a little bit more efficient. And so they're able to assemble the cars quicker compared to your traditional ICE vehicles. What's most important is actually the battery cost. The batteries make up about 30% of the overall cost of your EV, so it's quite a significant portion. Given improvements in technology and reductions in battery costs, this has actually been able to drive down prices for its EVs while actually maintaining some of its margins. So you can see here in the chart, over the last 5-6 years or so, Tesla has been able to drive down its average cost per EV from about $75,000 to about 40, around about $40,000. So it's quite a significant cut in terms of your prices. And it's very significant because it opens them up to a larger margin, like your mass market. The mass market right now is still in the $25,000 to $35,000 range. So they are still considered more on affluent mass market kind of target audience. But as they are able to reduce prices further, it opens them up to a wider range of consumers, which will only increase their volumes going out. And so that'll be a positive for Tesla. And lastly, net zero emission tailwinds. Don't really have to talk much about that, but definitely one of the biggest drivers for not just Tesla, but the EV industry as a whole. We have an accumulate rating on Tesla with a target price of $265. So my third counter will be Amazon. So for Amazon, they're starting to see the fruits of its efficiency enhancements. So firstly, they're seeing some margin expansion, and this is expected to continue. There are several reasons for this. Most of the margin expansion is due to a lower cost to serve, especially as inflation for goods has come down a little bit. Your supply chain constraints have almost normalized. At the same time, they've also been able to increase the efficiency of its delivery and logistics services. So it's not wasting too much resources there, and that's really driving up some of their margins. Secondly, AWS growth is kind of stabilized. It's actually been declining over the last year or so. On a year-on-year basis. Growth has stabilized roughly around a 20% mark, and it should stand to benefit from this surge in generative AI. As more and more, I guess, companies kind of want to leverage on generative AI, they need a platform, they need the infrastructure to do so. So instead of just building their own data center, which is asset heavy, it takes a lot of time. They just leverage on AWS to provide the server capacity for a lot of this generative AI work. So that should help to at least sustain AWS growth. For a period, quite a long period to come. Lastly, we're talking about advertising, which is not really talked about for Amazon because most people focus on AWS and their e-commerce business, but we think advertising is actually a big opportunity for them, mainly because they are able to collect a lot of their own first-party data, compared to a lot of sites that collect third-party data. So when you collect first-party data, you're able to. Usually, it's a little bit better in terms of being effective. Secondly, they're able to leverage a lot of this data to kind of leverage it in the ads that they put and make sure that the performance on these ads are a little bit higher. And lastly, usually when you're on Amazon sites and you see these advertisements, you're already ready to buy something. So the inertia for a consumer to actually click on some of these ads to buy maybe another product or a related product is a little bit lower. And that just translates to better advertising performance. So we think that these three factors, are going to help to drive Amazon moving forward. And that's why we have a buy recommendation on Amazon with a target price of $175. So my last counter is actually, NVIDIA, and that shouldn't be unfamiliar to everyone. Everyone should know NVIDIA by now. They're expecting a very strong second half of their fiscal year, mainly because demand is so strong right now. I believe they guide to like 170% year-on-year growth for the quarter that has just passed. So quite insane revenue growth for a company that is not really it's quite a mature company. So we think that this will even if it's not as strong the next few quarters, it's still relative to its peers and relative to other industries, it's going to be revenue growth is going to be still very strong. Secondly, we think that margins are going to expand mainly because of higher ASPs or average selling prices. So when it comes to generative AI, basically the only GPUs that you can use are sold by NVIDIA because they have to be high tech, high spec. And right now, NVIDIA really controls this market almost single-handedly. They're basically the monopoly here. So they're able to charge higher prices for its GPUs. But I mean, obviously, the newer GPUs that they put out are better in terms of performance compared to the older ones. But maybe if performance goes up by 50%, NVIDIA can essentially charge double, and your cost to actually manufacture your newer chips, obviously doesn't really double going along with it. So naturally, you'll see a little bit of margin expansion for NVIDIA for a lot of its GPU products. Our last point here is that we don't really think that there's going to be any effect from curbs on its Chinese business imposed, potentially imposed by the US government or by China, limiting business, with China. We have a buy recommendation for NVIDIA with a target price of $645 because we still think that NVIDIA is going to be the leader in generative AI for the near term at least. So that we've come to the end of our stock picks per se. Here's just a table of the companies that we cover right now, some of the target prices and some of our ratings for it. We can always show it later as per request. But with that, I will hand over to Zane for the technical pulse. And then after which we'll move on to our Q&A. So Zane, please.
Thanks, Jonathan. I'll move on to talk about the technicals for Nasdaq as well as S&P 500. Next slide, please. Yeah, next slide. Yeah, thanks. Okay, so for the Nasdaq, what we saw in third quarter was essentially a pullback from the main uptrend channel shown in the chart. So we actually hit about close to 14,500, which was actually the swing highs early of last year in the first quarter. So we actually pulled back from there, and there was quite significant momentum in the pullback as we actually broke down short-term uptrend channel during the process at the top there. And currently, we actually hit the back to the uptrend channel support close to about 13,000, confirming the lows formed in August. So for fourth quarter, we could expect some sort of rebound from this main uptrend channel support. Given that this holds, we could go on to test the downtrend resistance line that could bring us to about 13.8 thousand, or if we have a stronger rebound momentum, we could hit about close to 14.3 thousand, which was the highest in July to August this year. So for fourth quarter target for Nasdaq, we could see some sort of rebound towards 13.8K to about 14.3K. Next slide, please. Next slide. So for the S&P 500, the chart is quite similar. Third quarter, we also saw a pullback. So S&P hit about 4,600, confirmed the high swing highs in first quarter last year as well. Then we also broke down an uptrend channel, short-term uptrend channel, and following that, we actually pulled back to test the main uptrend channel support close to about 4,002. Currently, we are seeing some sort of rebound from as its price is being supported from there. So for fourth quarter, similarly for S&P 500, we could possibly see some rebound to test the downtrend resistance line. That could bring us to about 4,450 or to close to 4,500 to about 4,600 again. If we do retest the swing highs we formed in July to August. Yep. So for S&P, similarly, we expect possibly some rebound from this main uptrend channel support to end of the year. Yeah. So that's all from me now. I'll hand back the time to Jonathan to conclude. Thanks.
Thanks, Zane. So this comes to the end of our, presentation. Just in conclusion, it's the three main points. We still think that earnings headwinds is going to be persisting. At least for the rest of the 495 companies in the S&P 500. Secondly, we do expect the Fed to remain firm on its restrictive policy. We don't expect them to one day suddenly turn dovish and say that we're going to start cutting rates quite significantly. And lastly, we do expect AI related stocks to continue cooling down, especially after the hype kind of is dying down a little bit, and people are starting to realize that some of the valuations of these companies that aren't even making money suddenly get a little bit out ahead. So that's it for our conclusion. If you have any questions, feel free to post in the Q&A tab. Otherwise, you can always reach out and contact us.